Welcome to part 4 of the CTI Starter Course Analysis. So in this part, we're going to be looking at Fibonacci. Now, you may be remembering back to your school days when you did the Fibonacci sequence in maths class. Well, it's not quite the same thing, but it is based on the same mathematical principles. So if you don't know what Fibonacci is, or you're sort of a bit hazy with the memory, it's when you add the previous two numbers together to get the next number. So like 0 plus 1 is 1, 1 plus 2 is 3, 3 plus 2 is 5. That sequence going on forwards. Now, you may be aware of the fact that in nature, and like galaxies and things like shells and various other things in nature, plants, often conform to what's called the Fibonacci spiral. So essentially, it's this sequence, it's a pattern in nature that's based off the Fibonacci sequence. And surprisingly enough, this actually is a thing in trading too, in market analysis. And that'll make sense rather soon. So let's get started and look at what the Fibonacci is based on markets, and not necessarily the sequence that you may have learned in school. So the Fibonacci is a technical tool that we can use to measure the size of the retracement / corrections / pullbacks, also known as just B legs, during ABC trends. So the fact that it's only during ABC trends gives you a hint that you cannot use this during consolidating or ranging markets. So it's a tool that we use during trending markets to measure the size of the pullbacks and the size of those B legs, and also we can use it to potentially forecast the length of the C extension. So when we think of ABC, we're thinking of the initial momentum, and then the B pullback, and the C continuation, the extension is of the next leg, so to speak, because that C then becomes A of the next wave, and then you may expect a B and another C after that. So just to summarize really quickly, it's just a tool to measure the retracements in a trending market, and also potentially forecast the extension of the C. And all that will become very clear very soon. It's also used as a potential dynamic support and resistance tool. So remember back to the very first what support and resistance is. Then remember that trend lines, channels, ranges are all sort of forms that use that context of support and resistance. Even though they're not necessarily exactly the same thing, they can act as dynamic levels, like the moving averages too. It's something there's not an exact price, but the market is potentially reverting back to the mean, so to speak, for a moving average before it makes the next sort of extension, the next C leg. So it can act as a similar tool as well to give us those potential support and resistance levels, especially when used in confluence. Remember that word confluence, which is when more than one technical indicator is stacked on top of each other. So you may have a trend line support potentially being in the same place as horizontal support. Maybe a moving average is there too. Well, now also maybe you have a Fibonacci level, which will all become clear very soon. So let's look at support and resistance and extensions, because that's how we can utilize this in the first sort of instance. So there's different levels of Fibonacci. So when we think back to the Fibonacci sequence, it's a bit different to that. We're thinking of these sort of multiple levels that a lot of traders use that are very famous because they're used in different patterns. So if you look at Fibonacci in nature, if you Google that, Fibonacci in space, Fibonacci in nature, you will find that these, especially the 61.8, it's like the magic kind of golden ratio, that often you get these patterns conforming to Fibonacci spirals based on these particular numbers. And when it comes to markets, these are retracement zones. So 38.2 would simply mean that the market has retraced, it's pulled back 38.2% from the high to the low. Of course, 50% is pulled back half the way, and then 61.8. There are more too, like 78.6 that we'll look at, but these three are the main ones. So they're widely known, and because so many people use them, because they're so widely known, they can sort of be self-fulfilling prophecies too. If everyone's looking for the sort of golden ratio, that's 61.8%, you'll often find a lot of market orders there. So often you will get sort of reactions at these levels. So they can sometimes act as dynamic support and resistance for that very reason. Now, it can also be a predictive indicator. So when we mention the extension wave, the sort of the C leg of that ABC, the market is kind of predicted to reach these potential Fibonacci extension areas based on how large the A is. Because if you think about it, the longer the A, so the bigger the initial move, therefore you could get an even bigger, the bigger the next move could be. So if you have a really small A wave, and then let's say like a small B pullback, the C wave might not be so big because the initial A wasn't that great. But if you have a really big move to the upside, a really nice pullback, and a continuation, based on the size of that sort of A wave, the Fibonacci can predict the potential extension for that. And again, it might seem a bit strange in the moment, but I'll show you how this works on an example and on a real chart too. So these are the different ways we can use it. There are support and resistance, and also as a predictive indicator for the extension, which in a way is also support and resistance, because it's somewhere you may look to take profit, somewhere the market could bounce from, especially when in confluence with something else. So how does it work then in basic form? Now, here's an A, and here's a B. So there's our initial A movement, and there's our pullback. So we're measuring the percentage retracement of B relative to A. Now, that's 100%, and that's 0%. So think why that is. If you retrace all the way down to the low, you've retraced 100% of the A. And as when you're at the high, when you're here, you've retraced nothing because it's not come down yet. So it's the 0%. So there's, let's say, a 50% retracement. It's retraced half of the way. So it's halfway to 100% effectively. That's how these levels are measured and how they work. So that's a 50% retracement, as it's come back half the way from the low to the high. Now, if this was the other way around and it was a short setup, so a bearish market, then of course it would be flipped around. So 100 would be at the top, 0 would be at the bottom, and if it went up halfway of that downwards move, it would be a 50% retracement of that move. So you can just, all this stuff you can sort of flip upside down for the other side. Now here's another Fibonacci level that's quite well known, the 78.6. It's obviously a bit deeper, but it's another one of these known levels. So if we look at this in a bit more detail, here's an A, here's a B. So there's your 0% and there's your 100%. Now it can also give us extension levels. So when the market starts to make the C, you might be thinking, well, is there any tool I can use that might give me an idea as to when this might stop? And luckily there is. It's the Fibonacci tool. And when used in confluence with other factors, like let's say there's a really big level of resistance above market, and your D1/D2, which you'll see in a second, the two extension zones, let's say that level is in between those extension zones, you have a level of resistance the market might stop at, and also, based on the mathematical formula behind the Fibonacci, is extended the potential C wave to that zone as well. So I know it's a bit of a complicated one, this, but as we go through the examples, it makes sense. So there's your D1 and D2 extension. So the market may find kind of the end of the wave in that zone, because based on that initial A impulse, it makes sense on the Fibonacci spiral sort of formula where that C may stop. And again, combining that in confluence with other things is also quite good. So here's another A. So there's our 0% or 100%. Now let's think of the other Fibonacci levels, because there's more than just the ones we've looked at just there. So the main Fibonacci levels, and you may want to pause it, write these down because it's very important. The initial one, the 38.2, which will give you a shallow retracement. Because when you think about it, the lower the number, the shallower, the less like intense the pullback is. And of course, a really deep one, like the 88.6, is going to be almost down at the low again. And each of these levels can give us different information too. So the 38.2 is our first sort of quite shallow retracement. Now the 50/61.8, there are sort of what's called the golden pocket or the golden ratio, where a lot of markets, when they're trending, tend to pull back roughly to these areas. So about halfway to about 61.8%. And again, you can do research on Google about the 61.8% figure. It's found a lot in nature too. So it's like quite an ideal spot for the market to retrace back to and then continue on for the next sort of wave to the upside. Now 78.6 is a pretty deep retracement, so when you get down to these levels, the market's really pulling back quite far. And we'll tell you what this may indicate or how you can use this predictively in the next slide. 88.6, if it gets this far down, if it's a very, very deep retracement like this, is almost invalidated, because if you're that close to where you started, it's probably not going to form an ABC wave. Like 78.6 is sort of the last stand for the wave to actually form properly. So if you think about it, you get all the way down there on the B retracement, you're almost back to where you started. It might start ranging or forming some sort of pattern. It's not really a clear ABC wave to the upside. You wouldn't really expect the market to just go all the way down there and to start rallying back to the upside again, which I'll show you in a second. So the deeper the B, which is now sort of going more into what I just said, the longer the potential C. So these extension levels, of course, where that C may end, can give us an idea also as to how far it may go, right? So when we're looking at the B, when we're looking at 38.2, 50%, 61.8%, depending on how far the market pulls back, the characteristics of the C can sometimes be predicted somewhat by how far that comes back. And then of course the C, the extension levels, gives you the idea as to where that may stop. So let's look at that now. So this is a 38.2% retracement. It's quite a shallow retracement, quite small. Now it makes sense that if the market only pulls back this amount and starts going back up again, it's because the market's in a strong bullish mode. So the shorter the pullback, it makes sense that the C wave may be a bit more explosive and move a bit quicker and be a bit steeper. So therefore, you could have something like that. So quite a quick, aggressive move, because really aggressive trends that tend to go very, very quickly retrace less, right, which makes sense. So therefore, if you had a 50%, it may be slightly less. So a little bit less steep, but still pretty decent, back into these levels. All the way down at 78.6, it might take quite some time, because the deeper that retraces, the less buying pressure there is. It may take a little bit longer. You could get some, some volatility in between. Whereas if you just retrace to 38.2, you may just get a couple of candles that just go straight up, because it's such a volatile, such a quick market. Whereas all the way down there at 78.6, it might take a bit longer for that market to actually recover, which can give you indications as to what's going on. And of course, the D1 and D2 targets, the extension zones, will be based upon the first A leg. So that doesn't really change. But this can give you an idea as to how you might get to that area and obstacles you might face on the way. So shallow retracements, steeper incline; deeper retracements, often gentler incline. As with everything in trading, it's not always exact. You may see a market that retraces 78.6% and just rockets upwards. It's not always going to be the same. But most of the time, this can give you a pretty decent idea as to what's going to happen. So let's have a look at this example on the chart to finish off with. Here you have confluences stacking together. Remember that word again. So if you look at the sort of the green box to start with, right, going across the screen, you have highs on the very left-hand side that's then broken above. Remember the idea from part one: broken resistance, tested as support, moves away. So that's a nice ABC, retesting and moving away. As you come back down into that level, levels don't really expire, they're always there in the market. The market starts to get bought up again as you approach the level. You test it again for a second time, move away again. And then you get a pretty decent sized breakdown. So you've now moved, you sort of reversed the trend from up to side. You can see at the top there's a bit of consolidation, then to downwards ABCs. You break through quite a significant level. Notice also the 50 moving average, like the white line, is also now, instead of supporting the price, is now capping the price. And it's in exactly the same place as the resistance level. And what is also there, the 61.8% Fibonacci, that golden pocket, the golden ratio, is in the same place. So not only can you draw this on after the fact, after it's already moved away, to give you potential extension levels at the D1, which is the minus 0.27. That's the D1 target. The D2 is going to be slightly lower than that. But it can also be there as a predictive indicator as well as to where it might stop to, if it kind of lines up with other things. So what you have here is effectively an A wave breaking down through support, a B wave coming up. As this breaks through and starts to turn, that's when you draw the fib from high to low. So you start the Fibonacci, the 100%, at, in this case, the high. If it's the other way around, if it's going up, start at the low. So in this case, you start it from the high, sort of click and drag it down, drag it to the right, place it on the low, so the 0% at the low. And then as it starts to come back up, of course, you need to know that it's retracing before you can draw it. It then gives you those potential resistance levels. So the upside where the Fibonacci levels are, and it also would then give you already the extension levels based on how long that A wave was. So you get the A wave, the B wave, coming up back into 61.8%, that golden ratio zone, back into the level, back into the 50 moving average, and then you start to move away quite strongly, and you may be then expecting a C wave to come after that, possibly. It doesn't have to, but this is the sort of stacking confluence and taking those probabilities into account. So I understand that Fibonacci might be maybe one of the most complicated part of the series, because it's not the easiest to understand. But if you do need to go through that again, of course, restart the video, make sure you really understand it. You can then relate it back to other tools as well, such as support and resistance, and understand how they can work, and be comfortable also with the extension levels. So that's Fibonacci, and I will catch you on the next part.